Just like whispers of a coming storm in 1929 or murmurs of a bursting bubble in 2008, cracks are starting to show in the once unshakable housing market. Soaring interest rates, a web of credit concerns, and a glut of unsold homes cast a long shadow over the American dream of home ownership. This isn't a sudden crash, but a potential correction, a reality check for a market that's been on a scorching run. Here are reasons why the real estate sector in 2024 might crash, and many of you might fail to guess the reasons. The housing market might be heading for a slowdown, and the culprit could be interest rates. Rising rates, predicted to reach 8% by some experts, could make buying a home much more expensive. Think of it like this. Imagine a seesaw. On one side, you have home prices. On the other, you have affordability for buyers. When interest rates are low, the affordability side goes up, making it easier for people to buy. But when rates rise sharply, as Selma Hepp, deputy chief economist at CoreLogic warns, many potential buyers are priced out of the market. This isn't a sudden crash, but a shift in the market cycle. As analyst Rick Sharga from CJ Patrick Company explains, the real estate sector typically fluctuates in cycles of 7 to 10 years. We've been in a growth period since the 2008 recession, but now we might be nearing the peak. Higher interest rates mean that borrowing money for a mortgage becomes more expensive. This echoes what many analysts are saying. Affordability is the main concern, not a housing market collapse. So while a crash might be unlikely, rising interest rates could make homeownership a distant dream for many. Another usual suspect is inflation. Inflation, currently at a multi-decade high, erodes purchasing power. Even with steady wages, rising costs for everyday essentials have less money available for a down payment or higher mortgage payments. Rising costs for everyday essentials leave less money available for a down payment or higher mortgage payments. This creates an affordability squeeze unseen in the 2008 recession. Think of it like this. Let's say your income stays the same, but everything else gets more expensive. This leaves you with less wiggle room for a mortgage, making home ownership a distant dream. While a complete crash might be unlikely, this combination of rising interest rates and inflation could lead to a significant slowdown in the market. This could create a situation where sellers struggle to find buyers who can afford their asking price, forcing a potential price correction. The market might shift from a seller's paradise to a waiting game for both buyers and sellers. The Federal Reserve adds another layer of complexity to the potential housing market slowdown. Many people blindly accept the Fed's rosy outlook, neglecting to question the situation critically. This carefully curated story, as some experts suggest, might mask simmering problems. Fear plays a big role. The Fed might be hesitant to raise interest rates too quickly, fearing a panic among investors and shareholders. However, this focus on protecting financial interests could exacerbate underlying issues. Here's the concern. The Fed is a private entity, not directly accountable to the public. Critics argue that their policies, like keeping interest rates low for a long time, have inflated asset prices like stocks. This benefits the wealthy who own these assets, while everyday people struggle with rising costs. Furthermore, the Fed's quantitative easing programs, meant to stimulate the economy, are seen by some as a handout to big corporations and Wall Street. This could widen the gap between the rich and everyone else. Additionally, the Fed's role in bank regulation has been questioned, particularly after the 2008 crisis, where some argue lax oversight contributed to the disaster. The housing market's future seems increasingly shaky, with affordability concerns reaching a critical stage. Think of a healthy housing market as with two sides. Half represents homes available and the other half affordability. Currently, only about 25% of houses are truly affordable for average earners, a far cry from the ideal 50%. This, according to analysts, is the worst affordability level since 2006. The situation is further complicated by record-high credit card debt exceeding $1.13 trillion in Q2 2023, and this financial strain, unseen before, prevents roughly 20% of Americans from qualifying for loans due to high debt-to-income ratios. Take Idaho, a previously booming market. It's now grappling with a serious affordability crisis fueled by a combination of rising housing prices, crippling credit card debt, and increasing interest rates. Experts predict a necessary price correction in the next 18 to 24 months. And again, this isn't necessarily a crash, but a market responding to the harsh reality of affordability. The housing market's potential downturn isn't isolated, it's intertwined with a broader credit crisis that could create a domino effect throughout the economy. There are two main challenges: a lack of affordability for homes and a looming credit crisis. This extends beyond residential real estate. The commercial sector is feeling the heat too, with many office spaces facing high vacancies and looming repayment deadlines. The situation could trigger credit defaults, causing a ripple effect across the economy. It's not just one issue, it's a complex web of problems. Businesses struggling to stay afloat due to credit burdens can lead to declining revenue, rising unemployment, and ultimately decreased consumer spending. This weakness can then impact the housing market further. The work-from-home trend adds another layer. With less demand for office space, there's a surplus of commercial properties, leading to falling rental prices. The housing market's potential slowdown gains momentum with the unexpected downturn of the Airbnb boom. This once-hyped sector is experiencing record-low occupancy rates, posing a significant financial challenge for many investors. Many individuals stake their financial future on Airbnb, taking on risky interest-only loans to buy multiple properties. Now, with declining rental income, these investors face a harsh reality. Refinancing, once seen as a safety net, is no longer a viable option. This creates a cash crunch and exposes the vulnerability of their investment strategy. This problem goes deeper. The Airbnb investors are burdened with growing debt, but selling their properties isn't an easy escape. Depreciating property values means selling at a loss. Additionally, the income stream they anticipated hasn't materialized, amplifying their financial woes. Underestimated costs, a common pitfall for inexperienced investors, are now coming to light. The situation is further complicated by pandemic-related programs that may delay reporting of severely overdue loans. This lack of transparency could mask the true extent of the problem. The Airbnb bust is further complicated by rising unemployment rates and a threat of recession. Job cuts across various industries paint a concerning picture. This economic downturn, combined with existing financial burdens like credit card debt, creates a volatile situation. The lack of job security and financial strain will make it difficult for people to meet their obligations, potentially leading to defaults on loans and credit cards. This domino effect will exacerbate the housing market's troubles. When people lose their jobs or face financial hardship, their ability to access liquid assets diminishes. This in turn could trigger a wave of delinquencies on mortgages and other loans, further destabilizing the housing market. In simple terms, the affordability crisis, limited property availability, rising interest rates, and the potential for loan defaults due to Airbnb investments all point towards a significant correction in the housing market. Investors who miscalculate the income potential of these properties are likely to face financial difficulties. All these factors working together create a strong possibility of a housing market downturn. A new specter is also looming over the housing market: ghost inventory. Unlike the shadow inventory of the 2008 crash, these are newly built homes constructed by developers over the past 3 years. This surplus stock, particularly expensive single-family homes exceeding $500,000, threatens to flood the market at a time when affordability is already a major concern. This is a double whammy for builders who've been grappling with rising costs of labor and materials. As these unsold homes hit the market, a price correction becomes inevitable, especially considering the high interest rates. Unlike readily available data, ghost inventory might not be reflected in reports yet, but it's a real phenomenon playing out in cities like Boise, Austin, Las Vegas, and Nashville. But a slowing economy often leads to a decrease in consumer spending also, and housing is no exception. When people face job insecurity or economic anxieties, non-essential expenses like buying a new home are often the first to get cut. This drop in demand for properties will inevitably lead to price corrections, making it difficult for current homeowners to sell at their desired price. As a result, the housing market activity will likely slow down significantly, potentially leading to a crash. This concern is already materializing. Consumer spending has dropped by 4% in the first quarter of 2024 and is expected to continue declining. Reports suggest a shift in consumer behavior towards saving and holding on to cash during uncertain economic times. This cautious approach will further decrease spending, creating a ripple effect that negatively impacts the real estate market. And let's not forget foreign investment. The housing market boom relied heavily on foreign investment to maintain stable prices. However, the current geopolitical climate and rising protectionist policies are likely to discourage foreign investors from entering the U.S. market. This potential decrease in foreign cash flow could have a major impact on housing prices. With fewer international buyers, demand could drop significantly, leading to a potential price plunge. Data from the U.S. Treasury Department already shows a worrying trend. Global investment in U.S. real estate fell by 22% in the first quarter of 2024. In 2021, foreign investors accounted for a substantial portion of 7.8% of all U.S. real estate transactions. If this trend continues and international relationships remain strained, foreign investment is likely to keep declining, potentially destabilizing the housing market. But there's still a chance to stop this. Government incentives and programs can help make home ownership more attainable for middle-income earners. This could involve grants for down payments, tax breaks for first-time buyers, or encouraging the construction of more affordable housing units. Strengthening loan approval processes and promoting financial literacy can help prevent future debt crises. Additionally, exploring ways to help existing homeowners facing underwater mortgages, where the value of the home falls below the mortgage amount, could be crucial. Policies promoting a stable and well-regulated rental market are necessary. Measures like rent control, with careful implementation to avoid unintended consequences, or tax breaks for responsible landlords can help ensure a healthy rental market for those who cannot afford to buy. Remember, this is a complex situation with no easy solutions, but these are challenging times indeed. If you like the video, subscribe to the channel and watch our video on the ASEAN versus the EU.